Good day. Thank you for joining me. I'm Ryan Kuhn. I'm going to be taking you through AVI's half-year 2019 results. AVI is a high-quality food producer with a strong balance sheet and sound cash generation. The group has an attractive portfolio of leading premium brands with a good spread across market segments. Earnings and operating margins have come under pressure lately due to sales volume weakness resulting from a constrained consumer spending environment and consumers trading down on premium products. AVI is trading at a premium to the market. Although due to the strong quality and confidence metrics, we feel that the share price is currently fairly valued, trading at a forward PE of 16.3 times, ahead of its long-term average of 13.75. We feel that for earnings multiple to be sustained, earnings need to be ahead of peers, which seems unlikely in the absence of a consumer recovery. As operational improvements are likely to slow off the high current base, accordingly, we believe that peer companies offer better value. We believe AVI is a high-quality company with attractive operating margins, a high ROE and consistently strong cash generation. In addition, margins have been stable, the balance sheet is strong, and this translates into a high confidence rating. We are concerned that dividends may come under pressure in the current economic environment, as the company targets a fixed dividend payout ratio of 80%. Our prior underweight recommendation was based on a historical share price of R102.60, which contributes to our valuation concerns of AVI. Due to the decrease of the share price since the last report, our concerns over the valuation have eased, therefore we have re-rated AVI to neutral guidance relative to the JSE Capital Swiss Index. Looking at some financial highlights. Revenue decreased by 3% to 7 billion rand. On a like-for-like basis, revenue grew by 0.2%. This was due to IFRS 15 adjustments. The trading environment remains subdued because of continued pressure on consumer spending, resulting in sales volumes weakness. Adjusted operating profit dropped by 3.2% to 1.48 billion, while operating margins remained flat at 20%. On a like-for-like basis, operating profit decreased by 6.4%. This was primarily a result of depressed sales volumes and unfavorable movements in I&J's fuel hedges, resulting from lower oil prices at the end of the period. Diluted earnings per share decreased by 7% to 301 cents per share, and headline earnings per share decreased by 7% as well to 304 cents a share. AVI has had a consistent long-term half-year dividend payout ratio of 54%, which is affected by the movement in earnings. The current period is in line with history. As a result, the group declared an interim dividend of 165 cents per share, down 6% from the prior period. Looking at the cash flow. Cash flow from operations increased by 7% to 1.2 billion due to higher cash conversion. Capital expenditure came in at 290 million rand, which reflects AVI's continued investment to grow and sustain the business. Free cash flow decreased by 2% as a result of the increase in capex. Free cash flow that was generated was more than sufficient to cover the sustainable dividends. Moving to prospects. The trading environment is expected to remain difficult with constrained consumer spending. Many segments are expected to have low growth rates until there is an improvement in the South African economy. AVI's brands remain healthy and show sound levels of profitability at acceptable demand and sales volumes. Competitors are expected to continue with aggressive discounting, which would cause margin pressures. If you would like to place a trade, please speak to your financial advisor or contact the trading desk. A comprehensive company analysis report on AVI can be found on PSG Wealth's online trading platform. Before we end off, please take note of the following disclaimer. Thank you.